all of us who've written checks in the multifamily, in 2020, 2021, 2022, we are in pain. It's a fight to survive. Some of them might survive. Some may have a haircut. Some may have no haircut and may turn a profit, right? It depends.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast. Hey guys, welcome to the Legacy Podcast. I am your host, Tim Bratz. Today I'm sitting down with an old friend of mine, Mike Zlotnik. Mike is the CEO of the TF Management Group. They are lenders on all things real estate. And Mike and I actually did a big deal. I don't even know, 2018, I think. You guys came in for a couple $1,000,000 on a big value add project that we turned around. And I think we sold it in maybe 2020 or 2021 or something like that. It was like a 36-month turnaround. Made some good money on it. That was the heyday of multifamily real estate. We were just talking offline about how things have gotten a little bit tighter over the past couple of years and how we've been navigating that, both from an operator standpoint and from a lender standpoint, and what that looks like. So, Big Mike, great to have you, buddy.
Thanks, Tim. Appreciate you. And just for the record, we do a lot of commercial equity investments. So we do some debt investments too. So we've done a little bit of everything.
Yeah.
And yeah, that was a good deal in multifamily. I think you did good. So
Yeah.
ultimately, results were pretty good.
Yeah. It was, it was the peak of cheap rates and access to capital. Still a lot of deals that were out there since we bought it right before really things started booming, and then we sold it, kind of at the peak of multifamily. So that was a good one, but timing was on our side. Like I think it was a very difficult deal at the same time because it was such a heavy value add. I mean, we bought 700 units for $10 million, but then we had to put another like $15 million into it. So it was, and then there was carrying costs and everything else. But
And then there was
um,
COVID. I remember you had some
yeah,
challenges. You sold it post-COVID, and some tenants didn't want to pay rent, and you had all the
yeah,
post-COVID issues. But you still exited pretty good.
yep. Everybody got paid and made a great return on it. So it was that was a good one. But obviously things have changed. Maybe you can I'd love for you to kind of share a little bit more about what you do, all the different types of loans, all the different types of asset classes that you guys lend on or invest in, and kind of like kind of your journey over the past maybe 5, 10 years of how things have kind of morphed. And I want to talk. You're a very analytical investor, where you're looking at market trends, you're looking at data, and I really appreciate and respect that about you, because you get non-emotional about that kind of stuff. And hey, do the numbers make sense? Do they not make sense? What are the leading indicators in this space? And I want to dive into a lot of those components during this episode, if you're good for it. So, if you would maybe give a little bit of background on your fund and the Tempo family of investments and what that looks like over the past 5 years or so.
Sure. So, yeah, I'll just start. For those who don't know, people do call me Big Mike. I am 6'4", kind of a big guy, and years ago, through another mastermind community where I started a podcast, Big Mike Fund podcast, and simply mutual friend Corey Boatwright gave me some feedback. Hey, you are you're Big Mike, and you're a fund manager. So we've been doing quite a bit of investing in everything. So let me start. We started 2009, post Great Financial Crisis. We've done a lot of short sale flips, funding, and then we've done a lot of hard money loans over the years on residential properties. And then 2017, we kind of heavily moved into commercial real estate with our first equity focused fund. So the journey continued over the years into more commercial investments. We've done industrial deals, open air shopping, multifamily, self-storage, number of niche lending strategies. So it's a broad mix of type of deals and loans. Today we're mostly focused on equity, although will do some private credit, some debt. And the journey obviously evolved with times. If one thing that I've learned over the years, very, humbling experience, of course, market cycles, right? If you didn't see it or you saw it, didn't do anything, most of us kind of didn't even realize it was going towards a peak, although you could argue, the rates were at a low level for too long. At some point, things could have changed, but we didn't know that. 20 years of ZIRP, zero interest rate policy, right? So one of the basic observations from that reset is darling of investing in commercial real estate, multifamily asset class went through a massive market reset, fast and furious change because it was very sensitive to the interest rates. And some other strategies have held up remarkably well, like industrial, open air shopping, because they borrowed with fixed rate debt for many years, very predictable income. So the lessons learned, or one of the most basic observations, is you gotta kind of diversify more and focus on more predictable strategies and respect market cycles. So that's kind of been the change for the last few years of our focus, where we're no longer looking for the best upside. We're looking for more downside protection, predictability. Everything has to be income focused. And in today's environment, if you don't get good income from day one, don't do the deal. We don't do ground
Mm.
up construction. We don't do any deals that require heavy value add any longer. If I can buy at a 9 cap today and finance at 6.5 today, get the cash flow today, and then get the growth because you buy right. And it's very simple. So we're looking for more simplicity, more predictability, less speculation, more clarity. I don't know. But whatever it's worth, that's kind of the state of the mind.
No, I agree 100%. I mean, we've made a big focus in our own portfolio of like, guess what? After I bought, I mean, say the number, 1,000 doors, 2,000 doors, 5,000 doors. I didn't need to do heavy value add anymore. And I kept on buying heavy value add. And I'm like, why am I putting myself through this brain damage? Right now, there's construction risk, there's lease up risk, there's financing risk, right? Like, there's all these additional risks that come with new construction and heavy value add. Um, where if you're buying it right and there's enough meat on the bone and you're not spread too thin, it can make a lot of sense to buy those kinds of deals. Um, and if you can manage the construction side of things, you can manage the project. But at the end of the day, it's like there's so many risks. And I can tell you single-handed, like personally, from my personal experience, the new construction projects that penciled like they were going to be home runs typically turned out to be base hits at best. They are always over budget and always over timeline. And the stuff that I bought that was already built, already occupied, and we knew that we could just bring operational efficiencies in place. It was already, 80, 85% occupied. So there was I could get decent financing on it. There was no risk to the construction side of things. There was no risk to the lease up side of things. It was just an operational play of being able to go in, bump up rents, maybe put some cosmetics on the property, but not have this mass exodus of tenants or anything along those lines. Those ones turned out to be triples and home runs. Like it's and far less risky, far less stressful, all because I just bought good properties in good areas with good debt and didn't take on all those additional risks. And I'm fairly seasoned, right? Like I've done 6,000 rentals in my career, and I still get kicked in the teeth on the new construction stuff and the heavy value add stuff. And it's like if you can go and find great deals like you're talking about, I think that's the play. That's where we are right now. I think early on in my career, I needed to do those heavy value adds in order to build up the equity and the balance sheet in order to then qualify to get into nicer stuff. But to your point, that's not where you want to stay. Like move over as you mature from being a broker to being a wholesaler to being a flipper to being a buy and hold single family to being a small multi to being a big multi to being C class to then B class and then A class. It's a graduation that we all go through, and we need to continue evolving as our business evolves. How have you seen these market cycles? Because you had mentioned retail being a great investment class over the past few years. That wasn't a great investment class in 2020 when COVID hit, right? And all of a sudden, a bunch of these retailers, I remember a Cheesecake Factory put out a press release during COVID that says, we're not paying rent on any of our properties. I won't eat at a Cheesecake Factory to this day, because of that mentality. But they stopped paying rent, and a bunch of retailers stopped paying rent to their landlords. And so it wasn't a great business class to be in or investment class to be in, but then it has turned into a great investment class. These outdoor shopping areas and those kinds of things. How have you looked at? Are you looking at it from a investment cycle on a per asset class basis? Are you trying to time some of these things, or is it just based on, it doesn't matter where we are in the cycle, up, down, whatever, if it cash flows today and we understand that over the course of the lease term of 5 years or 10 years, there will be rent escalations, it meets our exit plans. How are you navigating some of that and underwriting those deals?
Sure. So, what you just mentioned is a temporary dislocation. Like everything in the world saw a very short-lived, very severe recession with COVID and a fairly quick recovery because of all the government action. The rates went down, the infusion of capital, ultimately level of reopening, and all the help that folks received. So on the retail side, especially open air retail, just to be very clear, supply has been very, very limited. So what we've seen over the years, and this is a long trend, there was fear of Amazon effect, e-commerce many, many years ago.
Mm-hmm.
Deliveries, obviously it picked up during COVID, but what's really fascinating is that people still want to live their life. They still want to go. So experiential and service-oriented retail continues to do
Agreed.
relatively well. Uh, and it's kind of crazy. You could see all shut down malls, and 5 minutes drive from there, open air shopping plazas are just doing remarkably well. So today we also need to, pay obviously close attention to what's happening in the economy, AI, kind of the impact, the K-shape, kind of U.S. 60% paycheck to paycheck, 10% are doing remarkably well, and then 30% is in between. All those things do play a role in retail. But in general, retail, similar to industrial, very different from multifamily because they actually operate on long-term leases. So credit quality, the tenant quality, location, the type of property matters a lot. So if you get a great location and you get service-oriented shopping center, great anchor, you see actually phenomenal long-term predictability of performance of these leases. And are we due for a potential recession? The answer is yes. I think the multifamily and ability to pay rent will be in worse shape than folks, paying rent on a long-term lease, on a 15, 20-year lease with a Starbucks or other quality tenants. So the observation has been there are market cycles in retail, but we've seen very little supply, and the rents are still doing remarkably well. And the other really interesting thing in retail versus multifamily, and we see the same thing in industrial. Where can you buy properties with a 2% positive spread between, or better, between the cap rate and the interest rate? That is today, it's been our underwriting box. There's a few other conditions, but we apply that concept today. We applied in the past. So if you can get a shopping plaza, we did a shopping plaza in San Diego, 9.25 cap rate early in the year on purchase and 6.5% fixed rate debt for 10 years, right? That's a 2.75% positive spread. Of all tenants, one of the tenants is the Cheesecake Factory, and they're doing really well. So I know you hate their guts, but in that location, it's downtown San Diego by the very,
That's
very
funny.
close to the sea. It's part of the seaport. It's very close to the convention center. It's got a great location. They got Cheesecake Factory. They got Starbucks. They got Eddie V's. They got, great ice cream place. That location is just superb, right? It's just so it's all about you got to get the right location. You got to get the right tenant mix. So what I'm saying is that can you find 2% positive spread in multifamily? It's harder. Certainly, the mindset is to find deals today, even today, with 2% positive spread. Now, it's not going to be Dallas. It's not going to be some of these southern markets. But we've seen this is the crazy part. And many of your folks who listen to your podcast are multifamily guys and girls. And I can just tell you this we have seen um, deals that are, let's just call them less than 10 years old, relatively new properties, quality product, call it Class A or better. trading at these insanely high cap rates if there's a seller motivation. So what I'll tell you in this environment, with that mindset of 2% positive spread, if you find that in multifamily, you're probably getting a great home run deal. If you find it in retail and industrial, you got many years of predictable play because of rent escalation clauses. Every year, rents go up 2 to 3%. Doesn't matter what happens. If you got a Starbucks as a tenant, what do you think is going to happen with a corporate guarantee? Even if they hate that location, they have to shut down the store. They're still going to pay you for the duration of the lease. So my observation over the years, the difference between storage, multifamily, retail, and industrial, right? Just do one quick comparison. Storage is month-to-month rent, right? If you have oversupply and you got more product than the demand, you're cooked. You're literally cooked. You're destroyed in that location. Multifamily, you need the balance still. You need inbound migration over time. You can stabilize probably faster than storage. But if you're overbuilt, you're struggling with this. Open air shopping, you're dealing with the typically from 5 to 15 year leases, some cases even longer. So you have a long-term lease predictability. You go industrial, we often go 15 to 25 years. So what's really fascinating, if you're on your journey to more predictability, stability, and ease of execution, property management is much, much, much easier on industrial, especially triple net leases, right? Same is true on open air shopping. There's still some property management, but much, much less. So this is the mindset. It is just basically go to simplicity, go to predictability. Can there be a market cycle? They can, but the cap rate's already reset. So just like multifamily valuations reset because the cap rates expanded when the rates spiked, most of the open air shopping and industrial cap rates expanded, and they generally trade. Their underwriting is 150 to 200 basis points positive spread. When the rates were low, you could buy, a shopping plaza at maybe 7 cap rate and finance with 5. Today, you could buy it at 9 and finance with, 2% less. So the same philosophy applies, and I actually feel, this is my opinion, that as interest rates hopefully cycle down, the asset classes that will see a lot more tailwind a lot faster will be industrial and open air shopping because they're easy to run the math and easy to execute. With multifamily, when we see the rate cuts, you got to clear all the sludge, all the problem properties that are in some kind of receivership or extended pretend loans or other problems that we've seen quite a bit of. So it's kind of very interesting. You see very limited distress on the industrial and open air shopping, ton of distress in multifamily. And when the market starts recovery, it'll probably be, it can be. I mean, I don't know. I don't have a crystal ball. But I think the interest rates will actually help those asset classes that are doing relatively well versus multifamily, which will get help too. It just might take a little longer for the market to absorb all the supply and for these financial stress conditions to clear out so that inventory can no longer be distressed and transact at normal prices.
This episode of the Legacy Podcast is brought to you by Legacy Family Mastermind. I know what you're going through. I know you feel stuck in small deals trying to figure out how do you get to that next level. I know it's hard to raise private money for real estate deals the way that the economy's been over the past few years. There are probably properties in your portfolio right now that are either losing money or at best break even, and you're trying to figure out how to turn them into winners. Or you're thinking to yourself, dude, I just want to be able to go on vacation without my business all being on my shoulders. Not having the time freedom or the financial freedom that you thought real estate was going to give you, I see it over and over and over again. But I've got the solution to every single one of those. Legacy Family Mastermind. This is a group of high-level commercial real estate investors that can help you break through every single one of those bottlenecks and help you get to that next level. I mean, you know the saying that when the student is ready, the teacher appears. Here we are. If you are serious about scaling your rental portfolio, we are here for you. This is the group to do it with. We would love to help you on that journey and design the exact life that you want to design so that way you can live it to the fullest. The next step is simple. Just schedule a call with my team at the link below and we'll see if it's a fit, because I want to see you sitting at the table with our Legacy family. Let's go build some wealth together. I think it's a great. I've looked a lot at triple net. I've looked a lot at retail and flex space and long-term leases and things like you're talking about. The limitation that I've seen is that you can't create upside, right? If you have I wouldn't say cheap money, but lower cost of capital, and you have patient money that can wait 7, 10 years, whatever, as these rent escalations uh, increase. Um, that's a great situation to be in, and I would go and collect as much of it as humanly possible, and
Patient
just
money,
cut a
you said this.
coupon. And how
Yeah.
how have you been able to? Is there a play to create value? Is there a play to push value valuations? Because I think for some people who are building a portfolio, they need to create the value because they're working on shorter timelines. They have to go cycle their investor money back in within 5 years versus a 10-year term. Um, I mean, obviously it can be made on the purchase, right? The more you negotiate the purchase price, the acquisition, that's really where the play is, and then trying to make a spread from there. Are there other ways that you've seen to create, or do you guys look for, a 5 unit retail outdoor shopping, open air shopping center, and three of the units are leased, or four of the units are leased, and one of them's coming up for renewal? Are you looking for those types of value add components, or are you guys finding stuff that's already on a 10-year, 15-year lease, fully leased out, and you're just paying, cutting a coupon and sitting on it?
Yeah, great commentary, Tim. So I would say there's a few different things. One of the ways to think about triple net industrial, in my book, it's risk profile, and every investment, the returns have to be commensurate with the risk, right? So
Mm-hmm.
if you're looking at the value add deals, which includes ground up and heavy value adds, you're trying to hit IRRs, call it, low mid 20s or higher, right? You're trying to get high up there. On these industrial deals, you're not trying to hit those. You're trying to hit mid to high teens very predictably. And it's most of the growth comes in simply through the rent escalation clauses. We're
Mm-hmm.
literally working on a deal right now, 8.6 cap rate on purchase, 8%, 8.6 cap, finance 6.3, and 2.75% annual rent escalation clauses. So your cash flow is very solid from day one, and your appreciation is forced through absolute triple net, right? Is there value add creation? The value add creation is to structure the deal to buy the property, and that's it. There's really nothing else there. So
Mm-hmm.
this is not a value add deal from the point of view that you're gonna suddenly create value. Where you could add value add, you could talk to the tenant, they need a new roof. You can capitalize the project and get them a new roof. Normally on the triple net, the tenant pays for that. But if they need a little bit of liquidity, and they're willing to pay you higher rent, and you could build it into the rent, right? You could basically capitalize that. On retail, interestingly enough, there's a few value as we've seen. One is out parcel development and sale. So you could pick up the whole shopping plaza at, let's use an example, 8 cap, and you sell an out parcel, with Starbucks at 6, right? I mean, Starbucks is traded at a great discount. Lower cap rate, not discount, but they trade at a higher cap rate.
Right.
Or you could do, if you have vacancy, right? So the open air shopping that I mentioned earlier in the year, it was bought at 9.25 cap rate with 84% occupancy. So you have 16% to lease up. So
Mm-hmm.
depending on the shopping plaza, depending on location, if you have quality leasing agents, regional players, you could figure out who'd be a good fit. You can add value by basically figuring out what tenants you can put there. So these are kind of the basic strategies on a shopping plaza. It's the out parcels, the tenant mix. You could also do you can generate more traffic for your tenants, right? So if you invest in a property and you do a bunch of promotion and you bring in more traffic that generates more business for the tenants, depending how lease is structured, you can get a percentage of that upside as well. So there's
Mm-hmm.
ways to add value, but it's different from multifamily. You're not, rehabbing these units. Of course, when you have a new space that you're trying to lease, tenant improvements, right? If you can custom build, you can negotiate lease the right way. Either they do their own build out, or you capitalize it and then you build it out for them and you collect higher rents. So what I would say is there's not a single strategy that meets all possible scenarios, but it's a different versus multifamily. It is so think of it this way: highest risk in real estate, you're talking about ground up and heavy value adds, right? Then you come down and you have open air shopping somewhere with target returns in the high teens to maybe low 20s. Then you come down and you go into the triple net industrial, maybe flex industrial, where you are okay with returns in the mid to high teens, very much more predictably. Now, if you do flex industrial, you still have some vacancy. You don't have a single tenant. Like example I gave you, the deal we're doing is a private equity purchase of the business and a sale lease back of the real estate. They don't want to own real estate, they want to own the business. So you get corporate guarantees. This is really coupon clipping. This is as simple as predictable as it gets. You just got to underwrite the tenant and their corporate guarantor. You're done. Is this like where do you get capital for that, right? You just have to find investors that understand that they don't want to deal with the difficulties and complexities of a value add project and the risks. They're comfortable with less return, but much more predictable return. The other way to compare, just to one thought, many people don't know this. So we do hard money lending, and the private credit has been a very popular way to deploy capital. All these hard money lending funds, you get the yield, let's call them, 9 to 11%. You could do a little more, you can do a little less. You got national plays, very competitive marketplace. Fix and flip projects, people go borrow. It can be a little more. I mean, but the bottom line is it's a, very high single digits, maybe low double digit yield. The risk profile on some of these industrial deals is similar to private credit, but their returns are meaningfully better. Plus, they generate still bonus depreciation, cost seg. You can still get tax shield, and you can get a yield of 7, 8, 9% from the get-go as an example, right? And compare that to the yield of like 9 to 11. So if you're talking to your investors and you're trying to raise capital and you're doing one of these equity deals, you're using conservative leverage, fixed rate debt, you have credit quality tenants, you could sell it on the risk level as a credit deal, but the returns are still better because you're in the mid to high teens. So there are
Mhm.
opportunities there too. You're just not shooting for these 20% plus returns. Can you wind up with 20 plus percent? We actually run sensitivity analysis, and like every 0.5% move in the interest rates, 0.5%, let's just call on a 10-year treasury yield, you can pick up about 2% of IRR plus minus, right? Because of cap rate compression. So you can actually do better. You could wind up, with target return 15, 16, 17, and can you hit 20? Maybe, yeah. Interest rates move enough, you can actually hit that. So the point that I'm making is that um, you could stick with multifamily, you could find great deals. But if you are a little bit more open-minded and you want to have less heavy lifting, this is a strategy that folks can consider writing a check. You just got to set expectations for investors and the principals, the sponsors, that it's not the same return profile as a higher risk, higher upside type of deals.
Mhm. Have you really good feedback? Have you guys do you also look at price per square foot? Because
Yes,
I've
of
seen
course.
it over and over and over again. People buying, like, it's very different. Building a multifamily property that you build for 150, $200 a square foot or whatever it is, versus an industrial property that you can build for $50 or $70 a square foot, but they both trade on a cap rate basis. And I think that can kind of be this lens, this um, that's kind of like a foggy, like a smoke and mirrors kind of a thing, where I understand the returns are there, but the reality is, what is this building actually worth if you did have to take it back, if the tenant defaulted, if you don't want to sue, or there, whatever that looks like. And how does that go into your underwriting? Do you guys put any weight on that, or is it mostly, hey, it's what we care about, the quality of the tenant, we care about location, we care about this and that? Or what kind of weight do you put on the price per square foot when you're buying retail versus industrial versus multifamily?
Yeah, it's absolutely a great question. So the price per foot very much depends where, right? So in San Diego, it's very different from, Midwest. You're going to
Hmm.
pay very different cap rates. You're going to pay very, very different. The cost of capital is similar. That's the crazy part. but the cap rates could be very different. And retail, you're looking obviously for special circumstances. But our underwriting box has three things. I mentioned one of them, and I'm going to mention the other two. These are big ticket items. Of course, what do you get, in rent per square foot versus what you're buying per square foot, right? That math ultimately translates to the cap rate mathematics because you're
Hmm.
getting, especially if you're buying an existing plaza, you can really see what the market rents are versus where the leases are. So one important metric is what kind of existing leases you have, because the value of these properties very much depends on the written lease. If the lease is below the market and they still have 7 years on that lease, I mean, you're basically preparing for that condition. Even though the market could be $60 a foot and this thing is at 45 a foot, right? So you basically you are a lot more linked and connected to the existing leases because they're long term. So it's a very important difference between that and multifamily. On a multifamily front, we want to have, I mean, this is the ideal math. I want property bought at 50% of the reconstruction cost. Obviously, there's an adjustment for the age, right? You have to adjust for the age and the condition. So if you can buy, multifamily at 79,000 a door, and the reconstruction cost of a similar new will be 180,000 a door, double, right? Then you kind of you feel you're getting a good price per pound of the multifamily. It's very different. Obviously, industrial properties reconstruct that huge, production facility today will be way more expensive than many years ago. But you got to look at what is out there. And at the end of the day, if you are buying with existing tenants, the only way we're doing this, we're not buying brand new construction and trying to find a tenant. That's a very different risk profile. When we buy existing and the company has been there for 60 years and PE private equity bought them and then leasing back, yeah, I mean, you do a little bit of that analysis, but it's less relevant because it's only lease, right? The building quality, if it's standing there, it's been there for 60 years, let it stand. So three things. Again, on multifamily, I like to look at it this way. I can't tell you exactly what should be the fair price today, but I want to be below 50% of reconstruction cost. How crazy does that sound? I remember we did a deal. We invested in a deal in 23, 2023. This is in Washington, D.C. area. Multifamily. It's a mixed use. There's a super Walmart on the first floor and 345 doors multifamily above that. 10-year-old construction. In Washington, D.C., to build something very, very, very similar, it's about 380, maybe $400,000 a foot. Why? Because it's just big freaking city. That's what it costs to build over there.
Yeah, union worker. There's a lot of red tape with getting permitting and approvals and all that stuff in place. Yeah, so it's just naturally more expensive in some of the bigger cities.
Acquisition was 190,000 per foot. So the acquisition price per foot was way better than the reconstruction cost. The reconstruction cost matrix is very important. It's the cost approach. So I
Hmm.
do agree. It's a part of the underwriting, and also the age, right? That property is 10-year-old. It doesn't need anything heavy. It needs some cleanup, spruce up, all that little things. So yes, discount to the reconstruction cost matters. I also want to see a discount to the peak of the market. So on that property, as an example, that property was what bought in Washington, D.C. I'm going by memory. It used to trade at 4.8% cap rate or something similar at the peak of the market. And it was acquired at, I think, 6.25 cap rate on purchase in 2023. So the way it worked is if you do the math, 4.8 cap rate and then 6.25, 6.3, that's like a 25-30%
I was going to say it's 30% discount.
bingo. So we still want to see 20 to 40% discount. That ratio applies to multifamily, it applies to other asset classes. So on acquisition, why 20 to 40%? I don't know, but the math seems to be justifying that on multifamily. It's justifying
Hmm.
it on open air shopping. It's actually justifying it on the industrial because the interest rates were so much lower. So the long story short, yes, part of the underwriting criteria is price per pound, price per foot, and positive spread on the cap rate to the interest rate. And then what's the third element? The third element is we did reconstruction cost. Yeah, so
Comparables?
reconstruction cost is one, and two is discount to the past value, right? So
Mm,
discount to the past value 20, 40%, price per pound per foot, and then the
cap rate
cash
spread.
flow.
Yep.
Yeah, three things.
Love it. Love it. What we've talked about what you're investing in now. How about investor sentiment, right? Because you guys raise money for your fund, take that money and deploy it in different projects. And we were talking offline before that there's been headwinds in certain industries or asset classes. And what have you found from an investor sentiment standpoint of what are investors looking for, right? I know you've alluded to they've invested in certain positions, and it seems like they want lower risk, more predictable cash flow. I think the big three are equity upside, right? And what does that look like? Downside risk of principal, the cash flow of actual cash flow versus accrued cash flow or preferred returns. And actually, number four would be the tax advantages as well. What are you finding that's really motivating investors to come into your deals and invest in projects as LPs today?
So this is very dynamic, just to be very clear. We are learning as we go. So we do know this, right? And this is the truth. And if anyone else, like we talked about this, if they're saying anything other than this, it's Bernie Madoff's, right? All of us who've written checks in the multifamily in 2020, 2021, 2022, we are in pain, right? Degree of pain varies. Some cases, these things are going south. Some cases, it's a fight to survive. Some of them might survive. Some may have a haircut. Some may have no haircut and may turn a profit, right? It depends. But we do know the peak of the market was then, and the market reset rapidly. So when things will stabilize are unknown, but for sure, a lot of investors' capital is stuck or worse. So as a result, you can't always go to the same people and ask for new money because the immediate answer, I'm losing money on this deal. It's got problems. It's a capital call or whatever. So get me my money back first and then we'll talk, right? So that
Mm-hmm.
conversation is very, very real. Um, we continue to try to find new relationships, people that are not scarred by the past experience. Also, there's really four buckets. I've actually presented at a conference not long ago. If you look at all your investor base, there's four possible permutations. Permutation number one, investor is upset and they have no money. Done. There's nothing to discuss. Next condition is the investor is not upset, but they got no money. You know, it's work in progress and trying to figure out when will they have money. Next condition, investor is upset, but they have money, right? How do you handle that scenario? And then the best case is the investor is not upset and they have money. So you just got to basically bring them the new deal and kind of explain the new benefits. So there's been a lot of flight to private credit and it works really well for self-directed IRA. But if you'll go look with cash, that thing is brutally taxed. So if people are looking for safety, predictability, private credit is good for self-directed capital, but it's not really good for cash. So you got to bring them immediately some kind of deals where you have bonus depreciation. So open air shopping and industrial, by the way, is what we've been focused on. Although we've done some multifamily within the last 12 months, they will cost seg, right? Multifamily will cost seg better than the open air shopping and industrial, but open air shopping and industrial will still give you enough shield to cover cash flow for 5 years with the 100% bonus depreciation being back. So tax efficiency, you could definitely offer today. Don't need to be like 40 to 60%. You write a 100K check, you can get, let's call it 40,000 or more in bonus depreciation on a industrial property or open air shopping. It's enough to cover 8% cash flow as an example for 5 years. Just purely the math is all there. As far as capital raising, I mean, we're looking for new ideas literally
And so
today. Where else?
let me pause you there. So when you say it's enough to cover an 8%, right, for 5 years, are you still paying a preferred return, or are we not doing preferred returns anymore?
Of course you're paying.
Okay, so you're
Today,
still
I,
paying a
I don't
preferred
want to do
return,
any
but
deal
it's
that
just an
has no
additional.
no real cash flow. We,
You're
we
saying the
won't touch.
depreciation is sufficient to offset the cash flow that's being paid out. So there's a big additional advantage there.
Yeah, exactly. So give you example, the industrial deal we're doing right now. And I'll give you one more hint at what we're doing today. So all these old waterfalls with sponsor-friendly terms that are too good for the sponsor, you got to bite your pride and literally be much more flexible and give investors a bigger shake in the deal. So we're doing an industrial deal with a 10 pref, 90-10 split. So you're going to say, what the hell? How much money am I going to make? Well, what's important is you do a quality deal, you get results for your investors, and you worry less about making a killing on the deal. We can't pay
You're
10.
taking fees on that though?
Yeah, there's some acquisition fees. Yes. So you certainly can take some acquisition fees and you can take some asset management fees. So you're not starving, but you're not making like a bandit like in the past, in the manner of speaking, right? You're not making the same economics, and ultimately those economics didn't work out in the past. Like you projected your great returns, and instead, like you'd be happy to break even, right? So from a structure perspective, it's better waterfalls for investors. And then as far as how much cash flow it'll generate, like on this deal, the average annual cash flow, actual cash flow, will be over 8%. The starting cash flow will be somewhat less than 8 first year, but then it continue to increase every year. Then your pref is 10, your cash flow is call it, 8 with change. You're still under pref, but the pref continues to accumulate. The cash flow is what investors get, and then the depreciation is going to give them enough of the passive loss to shield it for all the years of ownership. Does it make sense?
Have you, 100% makes sense. When you talk about a 90-10 split, 90% going to the investors, 10% going to the operating partner gets some fees, but the investor gets a 10% preferred return. Maybe it's paid out at 5, 6, 7% in the first year. That gets caught up year after year. But that's where all the cash flow is going.
You're starting at minimum at 6. Like today, I wouldn't even look at anything if I can't get investors at least 6%. This is our box, right?
Right.
If I can't get investors 6% initial cash flow from day one after all the fees, all the costs, that's the minimum bar today. I want to be 7 or higher, but if I can get into 8s, that's wonderful. Why
Cash
6?
flowing
Because
two-day of distributions today, it's got to be a
from day
minimum of
one.
6.
Yes.
So how about, have you ever gotten the objection of, so I'm looking at this from my perspective of I have sponsored loans for people with less than 10% equity. I've brought money to those people's deals and they might have 10 or 15% equity. And that wasn't enough for them to pay attention to that deal. And they went and got another deal because this one helped be the deal I helped them with was a stepping stone for them to then be able to qualify for another project where now they own 40% or 50% of the ownership in this other deal. And then they neglect this property because they only have 10% or 15% ownership. That deal then goes sideways, and I have to step in to go take over the operations of it. And I dilute my own equity, and it hurts the deal, and timelines get pressed back. Have you ever had an investor say, like if I was investing in that, I'd be concerned that it's not enough meat on the bone for the actual operator to make any money. And that way, if deals go sideways, I totally get that you're paying me more money and I appreciate that. But if that deal goes sideways, it's not enough juice in the squeeze for the operator to pay attention to that deal. And to me, it's perceived as more risk.
Yeah, it's a great point, and I'll tell you this. So this is specifically applicable to absolute triple and industrial because there's really no property management. So what you're doing is you're really collecting coupons, and at least the data that we've seen, their tenant loss default rate is incredibly low, less than 1%. They don't lose tenant. Every single one of them, like they've done, like the folks we're working with, they've done like 140 deals. We're raising capital for them, and they've done 140 deals in less than 1% situation where they actually had one only that they had to go find a new tenant. So in those type of situations, because the property management is so easy and simple, there's nothing to step into, right? So it's a risk
That's a good
profile
point. Yeah.
significantly lower. Now, if you go into heavier lift situations, you're going to say as a sponsor, you're adding a lot of value and you need to have a 70-30 split as an example. So yeah, it's a possibility that on some deals you don't go 90-10, you go 70-30, 80-20 because there's more work involved. So
Or there's a waterfall of some sort.
Yes, yes. So it's not designed for every type of a deal, but certainly you have to be a little bit open-minded on a very easy deals. Now, from investor perspective, we're basically trying to pitch these deals as highly predictable, lower level of risk. Your return profile targets are not as high, and people actually are very tired and very skittish of these high return targets because they were burned so much on them. So today, most people will be perfectly comfortable with a return target 15% and cash flow, let's just call them, 7% from the get-go with an average annual, whatever the number is. Now, you still need to connect with these folks. You still need to be able to convince them to take money out of wherever they've got it. There's a lot of wealth right now in stock market. There's a lot of wealth right now in crypto. And I know too many people, probably mutual friends, that have gravitated, they sold real estate, they put their money in crypto, and they've said, I don't want to bother with real estate because crypto, I'm going to make 20x in the next 5 years, and you are the idiots who are going to make 2x or 3x. And I respect that opinion. I've had these conversations. It's so crazy. And guess what? Listen, I don't know what's going to happen, but there appears to be a market correction there. And I continue to pitch to our investors that we see great value in commercial real estate because on fundamental basis, you have to sell deep, simple, predictable value, right? You're buying it at the high cap rates. You got the cash flow. The risk you're taking is well understood. Can you do well in Max 7? Can you do well in in AI stocks? Can you do well in Bitcoin? You certainly can, but that level of risk is way, way higher. It's so crazy. Some, old CG veterans called me and said, Mike, I got so much crypto, I can retire many times over. What do you got in real estate? Because these guys actually, come to a realization. You have opposite. You have like I had conversations with guys said until the volatility picks up in crypto, don't call me. Well, now it's picking up. I am actually reaching out because complacency is a dangerous thing and it's all wonderful until it's not. And now is actually the time to talk to folks who are sitting on appreciated stocks, who are sitting on appreciated crypto, and actually giving them an option of some diversification.
Yeah.
Right?
Now you
That's
you
one
and I
area.
see eye to eye on that in
There's a one more
100%
opportunity.
because what's that?
There's a one more opportunity, and I'm kind of working on this. Um, I talk to many guys in our space who are sitting with appreciated portfolios of residential properties, and they refinanced them when the rates were low, and then they appreciated value. How do you get liquidity out of that and invest in income producing? So I'm working on a solution that will basically give folks with appreciated portfolio of residential properties, your rental 100 doors, 200 doors, not a multifamily asset because those are different. But if you got 100 single doors, just as an example, there's a way to get some liquidity out of that and monetize equity, and then turn this into invest into income generating assets. So these conversations are all depends on where people have net worth, where they have capital, and what are they looking for from a risk reward perspective. When people are building wealth, they're a lot more kind of risk, you know,
Tolerant?
tolerant. When they are preserving wealth, they want very different story. They want more cash flow. They want more downside protection. And the downside protection is way easier to explain with 65% leverage, fixed rate debt, long-term leases. Can you do this in multifamily? You certainly can if you buy deep. We did a deal earlier this year. We 79,000 a door purchase with 1150 in place rent per door on acquisition, and it's about 35% off the peak um, in 22. Right? Can you do multifamily at that level? Sure, and especially if it's 1150 per door is well below the market. You still need to do a bunch of work, but the point is still the same. You got to demonstrate strong downside protection ahead of the all the wonderful upside today, and it's harder. I mean, we've all been humbled. It's almost crazy. It's 10 times harder to raise capital, but you got to persevere. You got to tell them your story. You got to tell why it's a great deal, and be able to be patient. Some investors may not be ready today. They may be ready in 3 months, 6 months. You never know.
Mm-hmm. No, I agree. I think I think you've done a great job of just staying course in what you're really good at and what you're an expert at without chasing the shiny objects, allowing other people to either get rich or go broke in buying businesses or buying cryptocurrency or buying Amazon stores or like whatever those other opportunities, the get rich quick kind of perceived opportunities are. Let them do that. And guess what? You stay the course. And if they go broke, you don't get adversely affected. And if they get rich, they end up taking their money back out of that and wanting to invest it back in real estate because they know that that's what preserves wealth better than anything else. And I think staying in your lane as a real estate investor without chasing shiny objects shows that you understand long-term perspectives. You got your guiding North Star that this is what I do, this is what my niche is, this is what I'm really, really good at, and I'm not going to be squirreling around going after these other opportunities. And by just staying the course, people then they come back. They always come back, right? It's like being the person who sells the shovels and the picks to the gold diggers. Let them go and dig for gold. You will show predictable revenue, income without the highs and the lows and still get rich, whether they get rich or not. And I think you've done a really, really good job of that. The other thing
Well,
that I think,
that's the mindset, Tim. And I'll just tell you this. I said this before, and I'll say this again. I've been humbled by this cycle the same way like everyone else. We certainly have sustained some significant, difficult files, etc. So one of the things that I've been spending a ton of time on is just um, reading, listening, reflecting, and spending time following some of the greatest minds. And I'm 53-year-old. I feel like an old cat. I'm turning 54, and you're younger than me, and some people are way younger. And it's like the wisdom comes with age, and you have to kind of go through enough of the learning experiences to get better. So where I'm going with this, I've been listening a lot to Ray Dalio. I've been listening to multiple of his books. One example is The Principles. And
mhm.
he has one of the very wonderful principles called pain plus reflection equals progress,
Yep.
right? You got to really go back to these wizards, the sages, the oracles of Omaha, Warren Buffett's Charlie Munger, Howard Marks, market cycles, Ray Dalio's, obviously, Benjamin Graham. They have such fundamentally solid knowledge. And all the folks that say, well, it's different now, these old cats have no idea, they're clueless, there's a wisdom in both. But what I'm saying is there's a book called Sometimes You Win, Sometimes You Learn, right? John Maxwell. So by going back and reflecting, what really it all comes down to is just staying in your lane. Exactly what you said. I was watching one of the old Warren Buffett's videos, and why he stayed out of tech stocks for a long, long time because he just couldn't wrap his head around these new opportunities. Maybe he missed a ton of opportunities. Nonetheless, he's done remarkably well over so many years. And I'm trying to just reflect again and again on these learn from these wizards. Just because the learning is a continuous journey. Life is just a continuous learning journey. We learn something, then we make a mistake, we miss a market cycle, and then you got to go back. And ultimately, in the long journey, you got to be in this marathon mood. And in the marathon mood, you're not trying to go sprints and make it like a bandit. You're really trying to build a foundation and a solid foundation so that, when there's a hurricane out there, your house is not destroyed by the wind. That's it. It's just very simple. It's what you said, but I just wanted to reflect on. By the way, those who haven't read the book, The Principles by Ray Dalio, I certainly recommend it. It's just a wonderful, simple. Um, you know, Ray Dalio, in his kind of old age, he's developed remarkable mental systems and strategies, as well as great approach to investment thinking. It's almost like whatever you invest in, real estate or anything else, you could learn from these folks. Even though Ray Dalio is not a huge fan of real estate, he's a fan of many other things. He's not necessarily a real estate guy, but he's got so many great wisdoms that you can apply to real estate.
Mhm. Yeah, I mean, he would be definitely top five, top 10 for sure, probably top five of all social media follows. Like I watch his videos and stuff all the time, and they're so good. To your point, he's got these great systems on looking at and perspective at looking at market cycles and looking at the value of dollars and currencies and these economies that boom and bust over time. And it's really really powerful perspective that he's got on that stuff. Um, the you know the other reason is like if you plant your seeds, some of those seeds don't populate in 2 years or 3 years or 5 years or even 10 years, right? Like by staying course and just staying in your lane, all of a sudden, an opportunity comes up 15 years from now that if you would have chased a shiny object or gotten out of the industry or got like moved over somewhere else, that would never have materialized. But by staying in your lane, the these dividends, these compound dividends start occurring on your experience, on your relationships, on your different learnings that you've had over time that you don't get if you jump around from opportunity to opportunity or chasing those shiny objects. So I think that is the I mean, Warren Buffett's a great example, right? Stays in his lane. This guy developed 99% of his wealth after he was 60 years old. You're a young cat, Mike, right? You got plenty of time. 99% of this guy's wealth came after he was 60, right? All because he stayed in his lane. And that's the power of the compound effect of just let the relationships compound, let the knowledge compound, let the experience compound. And all those seeds you plant for so many decades, all of a sudden, really, you don't just reap what you sow; you reap many times more than what you sow. And I think that's a powerful concept and to close on too. So, man, always enjoy our conversations, Mike. It's been way too long, right? We gotta maintain this these convos a little bit more often. And where can people get a hold of you? I know everybody's out there saying, how do I get a hold of a hard money lender, a Russian hard money lender who lives in New York City? They want to make sure that they can connect with you, invest in your deals, and learn from you because you got a ton of great knowledge, man. So I love it. Where can people connect with you, follow you, and learn more about what you guys have going on in the Tempo family and the Big Mike Fund?
Yeah, I appreciate it. It's going to be very easy and very cheesy. It's back to the bigmikefund.com. It's very that
Perfect.
simple. Bigmikefund.com. You could reach out. It's not a corporate website, but it's you could get to the podcast, but you can click from there to get to the corporate. You can schedule time with me. But if you misspell it, if you forget the D at the end, bigmikefund.com, I promise it's not a kinky site.
Somebody's, oh man, don't misspell it. Don't forget that D. Good stuff, man. I appreciate you being here, respect you and what you've built, and always being a great resource of knowledge, insights, perspective on things. And again, truly, we gotta stay connected on this stuff. So,
Likewise, Tim, I'd love to have you back. Well, I think you were a guest on the Big Mike Fun podcast a while back.
mhm.
So let's connect offline and then you can come as a guest. I'd love to have you. And yeah, I mean, I appreciate the kind invitation. I can come and speak to your folks from time to time. Hopefully, it's good. Hopefully, I'll add some value.
Awesome, man. Well, I appreciate you. Thank you guys for being here at the Legacy Podcast. We're here every Sunday. Don't miss an episode. Make sure you subscribe to our channel and click the little bell notification thing so you can get notified every time that we have a new podcast coming out. So connect with Mike, and we'll see you guys next week. Thank you.